Okay, we'll keep going then, but feel free to stop me. I'll stop, or feel free to put in the chat. So fun part, this is always puts everyone to sleep. Don't tell this if you're trying to get a date for Friday night. Don't talk about debits or credits, but this is what accounting is. Debits and credits explain, they really explain double entry accounting. And so debits and credits, you hear it, most people want to run, but it's pretty simple. All debit means is left, and credit means is right. Accountants use this to scare away other people from joining our profession, so we get paid more. It's super simple. Debit is Latin. It comes from a Latin word that means left, and credit means right. That's it. Don't think about it as anything else. Debit means left, credit means right. Debit is the left side of an account, credit is a right. So when we're doing a journal entry, the debit is the left side and the credit is the right. That's it. What we have here, it's called a T account. So we use something called a T account to make sure that our debits always equal our credits. The two major rules of accounting are assets always have to equal liabilities plus equity, and your debits always have to equal your credits. If you have that right, you're probably going to have your answer right, as long as you didn't mess up classification. So we're going to use these T accounts to track every account that we've talked about. What are some examples of accounts? Cash, liabilities, revenue. There's accounts for assets, liabilities, and equity, right? Each one has a series of accounts in that chart of accounts that we talked about. And each one is going to have a left and right side, a debit and a credit. So if we look at this, every assets on the accounting equation are on the left side, right? Can we all agree there? Correct. Liabilities and equity are on the right side. So because assets are on the left side, debit equals left, right? We know that debit means left. Debits increase assets. If we debit an asset, we increase the asset. Super simple. But if we credit it, if we credit an asset, we decrease it because it's on the left side. So they stay with their family, right? The debits stay with the debits. Debits stay with the debits. So assets, the left side will increase with a debit because debit means left. That's all it is. Left side will increase with a debit, decrease with a credit. Memorize this. Liabilities, because they're on the right side of the equation, what do you think will increase? What do you think will increase the right side of the equation? Credit means right. That's it. So credits will increase liabilities and equity. Debits will decrease liabilities and equity. Memorize this sheet. So anything that increases a liability or equity will be a credit, and anything that decreases will be a debit, while anything that increases an asset will be a debit, and anything that decreases will be a credit. Whatever increases an account is called a normal balance. So an asset has a normal balance of debit. Liabilities and equity have a normal balance of a credit. That's it. Don't overthink it. Really simple. Let me show you in the example that I have here. So if, let's say I invested money in my business, I would get assets, cash of 10,000. Assets on the left side. Debits are on the left side. So debit would increase my asset account. So I debit cash for 10,000, and then I credit my common stock. We'll go in these accounts specifically for 10,000. So my debits would equal my credits, and then my assets would grow by 10,000, and my equity would grow by 10,000. Assets would equal liabilities plus equity. We know our answer is correct. And we get this slides I shared with you. It will show you all the other statements as well. So that's all it is. You need to memorize that, and then it all comes together, right? Memorize that. So when I say assets, you have to know that means cash. That means accounts receivable. That means equipment. We have to know that instantly in our mind. We have to know that means debit increases them, credits decrease. So memorize all of these things. It's a lot of terminology, a lot of memorization. So the concept of double entry accounting is just that. Debits always equal credits. It means every transaction affects the accounting equation correctly, but also has every debit equals credits, and every assets always equals liabilities plus equity. That's all we're saying here. This is a good slide. I would memorize it. Key here for equity, just to throw a crux in it, is because dividends and expenses decrease equity, they are going to have a debit normal balance because they have a negative impact to the right side of the equation. And so let's see, I'll walk through T accounts later. This is a good slide that you should practice, right? Make sure you're able to identify the account and what is the normal balance. So prepaid rent is an asset. Because it's an asset, assets have a normal balance of a debit. Debits increase them, so it's a debit. Common stocks, equity. So common stocks, because they're equity, have a normal balance of a credit, so a credit increases it. Make sure you go through all of these and understand these in detail. Any questions? So this goes through how the recording happens. So we record all of these journal entries, right? This is the example of the journal entry right here, debiting cash and then crediting our common stock. We make our journal entry. So we identify the source transaction, we analyze it, we record a journal entry, and then we post the entry to a ledger. I'm going over simple transactions, but the stuff I do at my job, I might have what I've seen, I might be working on an IPO. That's a very complex transaction. So there's going to be a lot more to this step too. That's where accountants get paid a lot, is the analysis or the preparation of the financial statements. But where we're at, what I'm teaching you is the fundamentals, so you understand how it happens. And so we identify the sources. So it might be something as simple as a sale or as complex as an IPO or creating a new product. And then we analyze that transaction to determine the type of journal entry it should be. And then we're going to post it to the ledger. And then the ledger is made into a financial statement. And so when we journalize transactions, we need all the relevant information. We need a transaction, we need the date, we need the accounts, and we need the amount. We generally also put in an explanation. Like, hey, this is what happened on this day. And then what we might do for each account to make sure that we're okay is something called the T account. And so the T account is what I showed here, where I'm going to show all of the increases and decreases to a specific account. This is more of like a self-check. You wouldn't expect, you're not going to run a report that shows you all your T accounts. This is just going to show you the activity for a specific account. So you'd run a report on your cash balance, and that's what you'd get. Is on day one, on December 1st, we received cash of 30,000. And then on December 2nd, we reduced our cash by 2,500. We spent it on something. And then at the end of the year, our balance is 5,700. So this just shows you all of the transactions over a period. When we use the word posting a journal entry, that just means we finalize the journal entry for the system. So that's why you hear posting. It means that we've posted it to the general ledger. Take in mind, all of this is electronic now. You're not going to be writing this in a book at all. In honesty, most of this is going to be done by systems unless it's a very complex transaction. And your job will be to make sure those systems are doing it correctly. That's why you're learning this. Otherwise, you won't be able to check the systems. Okay, I think that's just background. That's a history, right? Nothing too complex there. Memorize the terms. And then ultimately, right, the goal of accounting is to analyze transactions and pull them into the financial statement. So processing the transactions, you could go through these slides, but I'm going to go through, I like my slides better that I've made, but you'll see that these are just more examples. So you can go through these examples yourself.